Welcome to Xcelerate with Shawn Redford. The Xcelerate Xcast is designed to provide Experior agents with simple, repeatable, and profitable strategies for you to grow your business. We will share ideas on how to identify ideal target markets and new opportunities, improve your conversations with proven scripts and storytelling, and finally, we'll also meet with industry experts and our partner companies to ensure we're up to date with the newest technology and insights, all so you're able to accelerate your growth. We hope you enjoy Xcelerate with me, your host, Shawn Redford. Hello, Experior champions, and thank you for joining us for today's episode of Xcelerate with Shawn Redford. I'm proud to have a returning guest, Dr. Rodney Mogen, joining us today to talk about taming the market. Now, what does he mean by taming the market? Well, we're talking about hedging risk. We're talking about using cash value life insurance as a hedge against inflation, market volatility, or simply to supplement your retirement income. So I hope you enjoyed today's conversation with our guest, Dr. Rodney Mogen of MassMutual. Well, hello again, Experior champions, and thank you, Rodney, for joining us again this week on Xcelerate with Shawn Redford.
Thank you, Shawn. I appreciate being here again.
And so, oftentimes I'm talking to our agents more and more often right now about retirement income planning, and we're trying to encourage our agents to look at fixed indexed annuities. And, our partners at Global View have been incredible in the RIA space. And one of the challenges that I'm coming across is a lot of our agents, they themselves are not experienced in understanding the markets, and they have challenges having these conversations with their clients. And we're going to go a little higher level here today. This is not an introductory conversation here, but I think it's important, especially in light of the reality that today we have access to information like never before. And, we've always looked at the markets as typically going up over time, but sometimes the ride can be a little rocky, a little bumpy, and it's important for clients to understand that. But I think with access to information like we have today, markets are more volatile than ever before. And so when we get on these runs of bear markets and bull markets, we want to talk and advise our agents and subsequently our clients as to how to navigate these challenges. And you have an interesting concept, strategy that you would like to share with us today, and it's called Taming the Bear Market. And so why don't you give our audience an intro, and we'll delve deep into this subject.
Perfect. Thanks, Shawn. Yeah, retirement planning is, I think, extremely important, especially for what we do. And I think cash value life insurance as a whole, and also fixed index annuities and the different products that Experior offers really help clients get to that retirement. But according to the Council for Retirement Research Institute, it's a long title, over 82% of people that are what we would call pre-retirees, so about 45 plus, and about 62% of retirees, so I'll just say 65, 66, I'm making an assumption there because they didn't really say an age, are actually really concerned about how are they going to get money out of their retirement. And so I think that your agents do a really good job of getting people to put money aside, to get money into the fixed index annuities, to also utilize other different products that are available. But I think, and everyone across the country, I think, does that as an advisor. I think they do a really good job of saving and getting clients to save. I think the problem is we don't always have an idea of how we're going to withdraw the money 20 years, 25, 30, 40 years down the road. So I call this more of a withdrawal strategy. And the time to talk about it is not at 65 when they're starting to do it, but it's to start doing it ahead of time. So where taming the bear market comes in is what we know about the market is that every 3 to 5 years, 3 to 7 years, there's going to be cycles. We're going to have a bull market, which means it's really charging and it's going up. We've seen that. And then we have bear markets, which means
grin and bear it.
Grin and bear it. Or the way I like to explain it is basically the market is hibernating. So it's not a
Yeah.
bear market during the summer, it's a bear market during the winter. So they're asleep for a period of time. And we're going to have those cycles. And when you're talking with your clients, the thing, and this is what I mean by having that withdrawal strategy, is when the market's doing well and you're pulling money out, whether it's a FIA, whether it's IUL, whether it's wherever they've got money saved, if the market's doing well, that's not a problem, because if you're pulling out 3% and you're doing 7% in the market, you're making money. It's good. However, what happens when you have the market is flat or it's negative for a period of time? You pull money out, you are now exasperating. Even if you pull out, let's say 50,000, you're really ideally probably pulling out about 75 or 80, because now you got to pull that money out there. So that could affect the long-term performance of the products and the different things that you're utilizing.
Yeah.
I'm not even talking about taxes yet, so we'll get there in a second. But that's where Taming the bear market comes in, is utilizing a more fixed product that actually has guarantees inside of it, has some different things in there that is not specifically tied to the market. So it's really going to work more as an inflation hedge and a market hedge, so that when the market is down, you can pull from there and let the other market-based assets, do what they're doing. So maybe it's you pulling from the market-based assets for 3 years while you have a bull market. All of a sudden, you have 2 years of a bear market. You pull from the fixed assets, and then you keep going back and forth. And then now you really are creating a more longer-term withdrawal strategy. Yeah. And the key part of this is also making sure that there's tax diversification. Now, I'm not a tax advisor. I'll just say that as my disclosure. But I like to, I was told this a long time ago, and this is how I always think of it, is I like to think of it as a three-legged stool. Now, being 7'2", I need a very sturdy stool, Shawn. So I want to make sure my legs are working. Okay.
Wait a minute, Rodney. You're 7'2"?
Yes, I'm 7'2".
Oh my Lord. You're twice my size.
Yes. Gee. Yes. I am 7'2". So I need a real sturdy stool when I sit down. Okay?
Wow.
So what I like to talk about is, a lot of people, especially if they're working at a job, they'll have a 401k, they'll have different things like that. So they'll have that bucket covered. So that leg is usually the longest and sturdiest leg, because that's where they put most of their assets. Now you may have someone that they've got that area covered, but they're also got money in what we call non-qualified. So in a brokerage account or, different things like that. They've got different stocks and bonds, and they got things in there. That one is generally not as long or sturdy as the other one, but it's pretty sturdy usually. It's the third area that is not really as sturdy for most people, and that is the tax beneficial or income tax free area. There's different areas that we can do that with, Roth IRA, things like that. And so, but almost all of those things are market-based assets that I was talking about. So I am not against doing a lot of market-based assets in all three legs of the stool. In fact, I think that's where you're going to get your biggest growth for it. However, it's having something that is going to provide you some diversification, both tax and investment-wise, that will actually also not be tied to the market, but is going to get you a better performance than, say, a CD, or a better performance than maybe some bond funds, things like that. And it's got some protections to it. So I can talk more in detail about it in there, but that's kind of just the overview of the concept.
Yeah. Well, and I mean, this is a really important discussion. I was just talking to one of our annuities supporters, at Quantum, and we were talking about the retirement risk zone. Yep. Those 5 to 10 years before and after retirement, when your retirement assets are really at risk. Those last 5 to 10 years, when you're dumping in probably annually the most savings you've ever had in your life, the greatest ability to save ever in your life, you're dumping all this money in, and you're banking on this being at its greatest value to carry you through arguably 20, 30 years of retirement, maybe as long as you worked in your lifetime, right?
Yep.
But what happens in year one? to your point, the market falls 10, 15, 20%, while you're also taking money out of the market. Not only, I mean, if you've got a 20% loss in the market, you need substantially more than a 20% gain to just make back that money. But if you've taken money out of the market as well because you needed it to maintain your lifestyle, well, that's a double whammy to your portfolio. And for many people, a 10% loss in year one is irrecoverable. So I love this idea, having another pool of assets that, should it be a bad time to take money out of the market, you've got choice, you've got flexibility. And some people build this liquidity into their retirement income portfolios, but not everybody has enough money to do that. Not everybody has enough money to protect themselves against risk in the form of insurance, but also build a robust, diversified retirement income portfolio that allows them that kind of flexibility. So this is an interesting take on that.
Yep. And it's a really good fit, where I'm, a lot of people might be, from when they're listening to me, they might be thinking, well, this is for those ultra high net worth or the ultra affluent. No, really, I think where this strategy really, really works, and don't get me wrong, it works for those people as well and those individuals. And you can do more with this strategy with those individuals. But, I've had a lot of success with this strategy with people with 250,000 in assets that are still growing, that, so I like to think 45 to 55 is a good ideal age range to start having this conversation. Now, maybe even sooner, but ideally, like you said, those are the ones that are starting to put money towards retirement more than they were before. Maybe their kids have graduated high school and they're off payroll, or, getting off payroll, or different things like that. So they have more cash flow. They also may have gotten into senior level jobs, so they've got a higher income, all different types of things. And they're really starting to think about it. Yeah. And that age group also has probably seen either a successful retirement from their parents or an unsuccessful retirement with their parents.
Yeah.
It's usually not somewhere in between, but there is generally a lot of different things that they're seeing. And especially right now with the economy going up and down, and with the global pandemic we had a few years ago, I think some retirement portfolios were irreparably harmed, to your point, especially if people were retiring at that time. And because they didn't have that backup. So this is where the taming the bear market is really keeping that. If that bear, to use my example, if that bear is hibernating, that bear market is hibernating, great, let it hibernate. We have something else that we can pull from. And what also at the same time is, and it is inside of an insurance product, so I'll just give you that headline right there, but you have this fixed asset, but now we can do a couple things with it. Number one, we have this fixed asset. The number two is, if the person that owns that policy were to die prior to retirement, or maybe mid-level in retirement, something like that, they now have a death benefit that can now fully fund the other spouse's retirement. So you're still ensuring that overall dream. The other thing that can be done is, potentially, if long-term care is an issue, we can also add a long-term care rider to this. And have that in there. So there could be a couple, I'm going to use a American football term, and really it could be a triple option if we really needed to do something there. But there's a lot of ways you can do it, but the key thing here is we are protecting, and we're trying to be a little risk averse with the overall retirement strategy.
Well, I mean, it really does become quite a comprehensive plan. Instead of just talking to the client about retirement savings and retirement income, you're now talking about, well, replacing income in the event of death, or supplementing your income needs, your increased costs due to a long-term care need in those retirement years, when again you're on a fixed budget, whether it's Social Security or the combination of retirement savings you've been able to put in place. It's still a pretty fixed budget that you've got to worry about. So that long-term care can be an incredible benefit for those individuals as well. So I like where you're going with this.
Yep. And it's also easier to talk to that client. Again, going back to that withdrawal strategy, is if you're talking to them about saving, you're talking to them about putting money aside. If you do have that conversation about, guess what? So Shawn, I'm just going to pretend you're the client here for a second. So, Shawn, we've talked a lot about, you've got some money in this account, you've got this stooled in there. We're going to move some money from this account over here so that we can get a little bit extra growth in this fixed index annuity. And then we also have a little security with it as well. It's got some guarantees to it. It's not going to go below. We can also turn it into income if we need to. However, what if we had a withdrawal problem due to the market? And what I mean by that is all of a sudden the market drops for a period of time. Mm-hmm. And what I always like to ask clients is, when the market is going up and it's doing what it's supposed to in your mind, how do you feel?
Exuberant.
Exuberant. Great. Now, think back to 2020, and I try to go to as most recent of a time as possible. Okay.
Yeah.
And that's going to bring up some feelings, but I always just say, go back to 2020 and think about the market. And the market went down almost 20% that year.
Yeah.
Okay? If all of a sudden all this work you've done, you're now about to retire, and now you got to pull money out because that's where you're pulling your income from, how are you going to feel?
Before or after I blame you for everything?
Hopefully you don't blame me, but before, we'll just say after. So
yeah, you start when you're at that point, you're stressed, you become fearful, and you might start to panic, and you might want to pull out of the market for fear of it continuing to fall.
Correct. So then what I then do is say, okay, well, if I can actually give you a safety net per se, so think of yourself like a tightrope walker, and you're no longer walking just on the tightrope, you do have a pretty strong safety net. It's not one you have to touch, mm-hmm. but when you need to touch it, you don't have to touch the tightrope. You can actually have that net that you can fall into and know that you're going to be safe. And then when the tightrope is fixed, meaning the market is going back up,
yeah,
then all of a sudden now you can start walking on that tightrope again, and you're great. But you always will have this net underneath you. Mm-hmm. Would that make you feel more secure when you're thinking about your retirement?
Absolutely. Yeah.
Yeah.
That's a great analogy. Great way to put it, Rodney.
Yep. And that's all I'm talking about is we're just creating that safety net. And then, like I said, we can expand that safety net to a couple other different things. If a premature death happens while you and your spouse have been working for retirement, you're in retirement, you can now fully fund the spouse's retirement with that insurance piece, mm-hmm. based on what you have pulled out, what you haven't pulled out. And then also if it really comes down to it, if you need care for whatever reason, we can add in a long-term care protection that will provide some coverage, and it will take from the death benefits, an accelerated benefit rider. But now what we've done is we have protected that tightrope, mm-hmm. 3 different ways with 3 different safety nets.
I think it's brilliant. So something tells me that Mass Mutual has a solution in mind.
We do. With this, like I said, we want, for the Taming the bear market, we wanted to really make sure that it's not, again, tied to the market. So you're going to want a fixed product that has got some guarantees in it. And, we have different whole life solutions where they have guarantees from 2% all the way up to 3.75%, mm-hmm. depending on how we want to do it. If we're really working with someone from 45 to 55, they're probably not going to want to be funding that policy till they're 90. So, they may, and that might be an option. So, our pay to 100 product is probably not going to be the best one for this strategy sometimes.
No.
But, our 20 pay or our pay to 65, our 10 pay, if you're working with a business owner, business owners really like this concept a lot, especially when you're also talking about transfer of value, because mm-hmm. now they're really starting to think about their business and their retirement at the same time. And most business owners, other than their ability to make an income, their largest asset is the business. So how do they get that value to their retirement? Because yeah, you can sell it, but 3 years ago, you could probably get 8 times the value you can now, at least in the U.S. market for a small business, than you are right now. The market is tight, the credit market's tight. People aren't able to sell it for what they thought they should be able to sell it for.
Mm-hmm.
So there are different ways you can do that. So there might be an 8-pay or a 10-pay strategy that we can do where we can take some profits of the business and transfer it out and actually buy these policies and do some larger benefit or larger premiums in there. And like I said, have all that in there. So we can make it very customizable to the client. And I do want to highlight that I do this taming the bear market not in replacement of an FIA or an IUL. In fact, I highly encourage that you do those as well, and you max fund them and you put assets in there and have this overall strategy. This is just a supplement to that to create that. So the IUL and FIA, that's the tightrope in my analogy.
Yeah.
The whole life policy is the safety net. And so, I want to highlight, because I get that question a lot. Oh, okay, so I shouldn't do this product, I should do this product. No, I think you should do both. I think you should try to find some type of combination, because I also understand the limitation of a whole life. You're going to get more long-term potential growth out of an IUL per se than you are out of a whole life, but you're not doing the whole life for significant growth. You're doing the whole life for that safety net. So again, if you're putting some money aside, you're in there, you've got that guarantee piece in it. So if we were doing a 10-pay, for example, with Mass Mutual, our guarantee is 2% for the 10-pay, but that's also our best cash value generation product. So we put money aside, it's a lower death benefit. We can really maximize cash value inside of there. We can have the long-term care protection if needed on there. And then we have that kind of grow in there. And so if they're retiring at 60 or 65 or 70, we now have a much better, robust plan along with everything else that they're doing.
Yeah, absolutely. And I mean, I agree with you entirely in terms of, well, a number of things. First of all, this market, the 45 to 55-year-old market, before age 45, predominantly people are going to have term insurance. They're not going to be putting much money into permanent insurance products because they've got debt. Their biggest asset is their ability to generate income. So that's what they should be protecting. And not to mention all the other expenses, especially if they have kids, right? So, they don't have a lot of disposable extra surplus money. So, you're in your 40s to 50s, you're thinking about your retirement, you've built up a decent investment nest egg, but now you're starting to think about that retirement income. You're starting to plan for it. And these individuals are the ones who already have those growth portfolios, as to your point, whether it's, IUL or retirement savings plans or some combination of the two. This is, I love it, the safety net. This is for those individuals who want that downside protection. And you're talking about a 2% guarantee. That's each year. I mean, once those dividends are credited and the cash values are credited to the policy, it's locked in. So it's that in and of itself is guaranteed. So, I mean, it really is creating a nice floor, much better than a 2%, but at least in any given year, you've got a minimum of a 2% growth rate. So that's a pretty exciting opportunity.
Correct. Yeah, I work with a lot of clients, and Shawn, you know this, when you're looking at an illustration, you're generally going to look at the non-guaranteed side, because that's the more sexier side.
Looks a heck of a lot nicer.
But the reason why I like this strategy is a lot of business owners or a lot of the clients I work with, and in fact, I've been working with a lot of your agents, and they're always well, my clients are really focused on this guarantee side. They want to see the guarantees that they really are interested in that. So I spend a lot of time, especially with this strategy, talking about the guarantee piece. Now, it's not as sexy, it doesn't grow as well, but when they see that, oh, okay, if I put in X amount a year for this amount, I've got this in there. And you can see them like on Zoom, just exhale, go, okay, so this is my pure true safety net.
Yeah.
If it performs better than the guarantee, then I've got an even better safety net, but it's not something I have to worry about.
Yeah.
And then they look at all the other different solutions and they're like, good, because I have the safety net, I don't have to worry about whether or not this performs at 7%, 9%, whatever it might be every single year. I'm okay if it performs at 2% or 3%. And what I tell advisors and agents all the time is this is also a safety net for you when you're working with your clients. And what I mean by that is how many of us have sat in front of a client, we're doing an annual review of one of the products that we put in place to help that client. But because Shawn, I think you said it, just because the market went down 10% or 15% doesn't mean that it just needs to do 15% the next year and you're back to it, right? Probably means about 25 or 30% that it has to do. And so if you have 2-3 years of that compounding together, especially if you're in like an FIA or an IUL where you pretty much have, I'll just say, a floor of 0 for the most part. With IULs, there's cost of insurance cost, but we'll just call it a floor of 0 in there. You wouldn't think the values would go down, or they may stay a little down, but they may also just stay flat. Now your client's going, well, now I've lost 3 years, towards retirement. I've done all this money. I'm supposed to have this, and then I don't have this.
Yeah.
But if you can actually say, yeah, but you know what? It's okay if the market's down because we're putting money in. We're going to actually see it grow a little bit more when it does come back. But that's why we're also doing this other bucket over here. And we have that. And so that's again, that taming the bear market so that your client is not as worried or stressed as that scenario you were talking about when the market's down, both when they're saving, but also especially when they're withdrawing.
More great points. First, you're taking the time to educate the consumer on the expectation. You're creating an expectation that the market will go down, right? A lot of our agents and advisors in the industry, not just Experior, but in the industry, they're afraid to talk about the fact that the markets do go down. The question or the conversation you should have with your clients are, what are you going to do when the market does go down? How are you prepared for it? Hopefully you're having a conversation with your clients. Are you prepared in the event that you're diagnosed with a critical or life-threatening illness, right? Mm-hmm. Are you prepared for it? It may happen. There's a 50-50 chance, and depending on which statistics you believe, that's going to happen. Are you prepared for it? That's my job, is to mitigate risk. Same in your retirement portfolio. Are you prepared for when the market goes down, which I love. And the other thing I want to comment on, I learned this in a sales training many years ago. And what I was taught was, if I'm having the same conversation that my competitors are having, I'm not differentiating myself, right? So by having this conversation, I guarantee you're having a different conversation than they've ever heard before. What that does is it creates a memorable experience and something that these individuals are going to talk to who about? Their friends and family, the people closest to them, who presumably you want to get introduced to, right? So, having these different conversations, bringing this different set of value to the conversation, as opposed to, I'm going to pick the best investment portfolio and it's only going to go up and it's going to average 6.5% and blah, blah. Like, no, let's have a different conversation. Let's talk about the value that we're bringing to the table. I love it.
Yeah. I want to add one thing to that, because it goes to what you just said there. Is a lot of times I see, I'm sure you do as well. I see probably hundreds of illustrations a day. And, one of the things that a lot of illustrations I see when we're talking about this withdrawal strategy, and I want to make this clear, a withdrawal strategy is not necessarily showing distributions in an illustration. Mm-hmm. A withdrawal strategy is, how are we going to offset different things and things like that? And I'm not knocking anyone that shows the distributions, because sometimes you want to show that client what's possible.
Right.
But I actually personally never show a distribution coming out of any cash value life insurance policy. I don't, because you and I both know this. Anything I show now, it's guaranteed 20 years from now, it's not guaranteed. It's not going to happen. Hopefully it does happen exactly that way, but I don't want to set the wrong expectation.
Right.
What I want to say is, and this is what I always show them, and again, this goes back to what I was talking about, that withdrawal strategy, is now we have different buckets we can pull from. And so when we need to do different things and we need different things for different purposes, we can actually have different buckets we can pull from, rather than focusing on one or two buckets and saying, okay, here's the income we can get, or here's this or that. And so I can show them, hey, we can pull out 100,000, 200, 300,000 for 3 years. And then we go over to this bucket, let this one, recuperate. We can do different things and we'll have different choices. And what's great is I've tried this strategy. I've tried other different presentations, different ways. And when every time I show it with the distribution, guess what the client focuses on? They focus on that distribution number.
Absolutely.
Well, how do I get more out of there? Or how do I do this? Or, what, but that's not the point of what I'm trying to show them. What I'm trying to show them is there's an avenue or opportunity for them to get money in different places. And, so rather than just show a max withdrawal off of one policy, I'd rather say, hey, if we really need to, we can pull 50,000 here. We can pull 50,000 from your 401k. We can do different things. Think about how that will actually lower your overall tax burden. Yeah. How will that differ? And having that conversation. So that's one thing I always talk with agents that I work with is don't get focused on the distribution piece.
Yeah.
It's something you can show. Don't get me wrong. I'm not saying don't show it. I'm just saying I don't show it because the client, they're going to forget everything you just said, and they're only going to focus on that income.
Yeah.
And then they're going to try to do, especially the analytical ones are going to take that illustration home and they're going to pull it apart in a spreadsheet. They're going to do all different types of things. And they're going to say, this is too good to be true, or this will never happen, so on and so forth.
Yeah. Yeah.
So I'd rather them not focus on that and focus more on an overall macro strategy. And then we can worry about the micro piece when we actually need to do it.
You're talking about those darn engineers. And Bobby, have you heard of Bobby Samuelson?
Yes, I have. Yes.
So, and Bobby, when he's talking about illustrations in particular, and he's been a proponent and an advocate for improved illustrations and more regulation around illustrations. In fact, he's written some of the regulations himself. Yep. But nevertheless, he talks about illustrations as not being projections. We have to stop selling them as projections, but rather use them as demonstrations. This is how these things can perform. Certainly not going to perform. The only guarantee is that I guarantee none of this is going to happen. It's the only guarantee I can give you in this illustration is that none of this is going to happen. And, as you were talking, I was thinking back to something you said earlier on in our conversation. And that was, or these individuals, the 45 to 55-year-olds, have the luxury of seeing their parents' retirement income strategies either succeed or fail. And the interesting thing there is many of them probably looked relatively successful because many of their parents were probably on defined benefit pension plans where they had guaranteed pension income for life, right? Well, Rodney, our generation doesn't have that. Those of us in our 40s and 50s today, very few of us have these defined benefit pension plans today. So their parents may have had a good experience, but it's our job to educate them and say, the reason why mom and dad did so well or looked like they did so well was because they had these guaranteed income streams. You don't. So you need to protect yourself from that downside risk, because that's what their employers did for them while they were working and retired for your parents. The employers took on all that risk. All that risk is now on you, which is why I'm here. And how I add value is I help to mitigate that risk.
100%. And I was trying to explain that without using Samuelsonisms. And so, but you sum that up 100%. I can't get enough of Bobby. Bobby really has it down really, really well. But I'll throw in another big industry player, and that's Tom Hegna. And, Tom and I are good friends. And one of the things that I always love with what Tom is talking about, and it fits into this taming the bear market strategy too, is it goes exactly to your point, Shawn. Our parents and our grandparents that we saw in retirement lived on a fixed income, but probably had a successful retirement because they had that pension coming in. They had that consistent income coming in with a little bit growth every single year. They didn't do anything extraordinary. They didn't do anything fun. But, I'm 47. I'm in that Generation X generation. My stepdaughter is a millennial, and we got the zillennials and all those different things. Well, what the reason why I bring all that up is I do a lot of work now, obviously with baby boomers still, and with Generation X, getting them ready for retirement.
Yeah.
But I actually have been reaching out, working with a lot younger advisors, which means I'm working with a lot younger clients.
Sure.
And what I'm trying to get to is those millennials and those zillennials, they are actually saving for retirement more so than my generation, and even more so than baby boomers were. But the reason being is because they want to experience things. So now they want to experience things now. So they put some money aside for savings. Those two groups actually have the highest savings rates of all the different generations over the last about 80 years. They are saving more because they also spend it more, but they're spending it on things to experience it. So their retirement is different than our retirement, or even what our parents or grandparents saw, because they don't want to live on a fixed income. They want to have that. And bringing that back to Tom Hegna is you can take a portion of that, you can put it into a flat income stream like an annuity, have an FIA and then turn it into an income stream down the road. And that's covering your bills. But then the other strategies we're talking about are allowing you to have distributions to do things that you want to experience.
Yeah. Yeah. Paychecks and playchecks, right?
Yes.
Tom Hegna. So why don't we take the last few minutes to talk specifically about which product at Mass you would talk to. I mean, you've already kind of highlighted it. The whole life product is the one, the tool that you would use. What are some of the features and benefits of the whole life product at Mass Mutual?
Yep. So, like I said, Shawn, we have a wide range of whole life products. So we've got as little as an 8-pay, meaning you're paying over 8 years, going all the way up to L100 or 100 pay, and we've got different ones in between. So you're going to want to kind of,
tailor.
I like to say that I like to say I'm a puzzle solver. So you're going to want to really take and find the right jigsaw puzzle or piece to put it into the puzzle for the client. But each one is going to have a little different feature to it. Some, like I said, the 10-pay I talked about has a 2% guarantee. The L100 has a 3.75% guarantee. So they're all going to have different things. So it's going to depend on what's important to the client there. But the really key feature to it, in my opinion, is you have the guarantee piece, but you also have the dividend piece. So the dividend piece is not tied to the market per se. It is, it's not a direct correlation. It is something that the company sets each and every single year. And it can change. It's not guaranteed, but that's where your advantage is coming from, because now you have this fixed growth that is better and working better than, let's say, a bond fund or doing CDs or doing a money market, things like that. You've got a little bit higher growth potential there, but there's also an additional advantage. Remember I said there was that triple option? So you have that cash value, but with how whole life generally works is that dividend option is for many years, you can let that go in and you can let it do paid up additions by an additional death benefit, which, going back to our stock theme, you are now buying more shares in the company essentially by having a larger death benefit, which means you now get a larger share of the dividend, which now means you grow the death benefit more, the cash value more, so on and so forth. And so you can start with a lower death benefit at 45 than, you don't need to do $1 million whole life policy is what I'm saying. You can start the strategy with 150, 200,000 policy, or even 100. And maybe by the time you really need the money, you've got $600,000, or, I'd have to run the illustration, but
sure.
But you might already have a significant amount of death benefit. Maybe it's additional 200,000 from paid up additions. Maybe it's additional 100,000 in cash value in there based on all those different things. So there's a lot of opportunities there for growth that you're just doing as this, tried and true strategy. So again, growing up, I stayed up a lot. I watched a lot of late night TV, and there was a guy that I liked that sold everything, and his name was Ronco Peel. And there was a phrase that he has, and it's basically set it and forget it.
Mm-hmm.
And that's very similar. I mean, you still want to keep a look at it and make sure it's working, but that's why I like whole life as part of the strategy. Is it's more of a set it and forget it, as long as you're paying your premiums.
Yeah.
And looking at that, and then you can be more active and aggressive with all your other different strategies.
Absolutely. Yeah. I mean, a lot of people talk about utilizing whole life as an alternative asset class in and of itself, like just because the insurance companies are basically the largest investors in the world. They've got billions of dollars that they're investing. They have access to
Correct.
products that we don't otherwise have access to. As a mutual company and a participating whole life policy, you are an owner in the company, and any benefits that come to that organization through cost savings or mortality or whatever is all going to be passed on to you. And it's always for the benefit of the policyholders, unlike a demutualized company or IUL products. And I'm not bashing IULs, it's just understand the difference. The shareholders are dictating the performance. The shareholders are dictating the amount of risk that you are able to take inside these accounts. So, it's a different mentality, and it's just important to understand the different opportunities, risks, and benefits of all of the products. And you're absolutely right. You don't need a huge death benefit on this, and you don't even need a big cash value on this, because really all you're looking for in this strategy, if we're talking about taming the bear market strategy, the markets usually recover within 12 to 24 months, typically. Right? So maybe you only need a year or maybe 2 of value in that account value by the time you hit that retirement date, right? Just to get you through those downturns so that you can mitigate those losses and allow your equity portfolios to recover.
Correct.
Yeah.
Yep.
Is there anything else you wanted to say before we wrap up?
The other thing I wanted to say is, well, 2 things, if you'll allow me.
Sure.
The first one is, I do get this question from your agents a lot, Shawn, so I just want to make sure it's very, very clear. And that is, we are a New York company, which means we are licensed to sell in New York, and
Yes.
you can sell our products that are in New York. You can sell them in all other 49 states. So it's the same product in there. So I get that question a lot, and so I just want to make sure everyone knows that we are one of the companies approved to sell in New York.
Yes.
The second thing is, I'm here to really, really help you. If I know whole life can be a little bit daunting sometimes, and if you don't always fully understand it, if you don't have it, I'm more than happy to get on a Zoom, get on a phone call with you and your client and explain it to them about how this fits in, how this strategy will work. I won't be trying to sell them. I will just be there to explain and to really just help them, and then let you do what you do best. But I do probably 35 to 40 appointments a week.
Yeah.
And the weeks that I enjoy the most are when I'm doing 50 or 55, because usually those additional 10 to 15 are me getting in front of a client with an advisor or an agent and explaining what I know best. And that's whole life, that's disability, but those are the things that I do really, really well. And I would love to have that opportunity. So, Shawn, I appreciate you having me on today.
Well, thank you, Rodney. And I will also say you've been a great resource to our agents, to our teams. If there's some training, I know that you're always welcome to help out either us as an organization or the teams all across the country as well. And I'll also give a plug, even though currently it's still conflicting with our ED locker room, but for anybody that's not an executive director, every other Wednesday, or at least the first and third Wednesdays of every month, right?
It's actually just the first Wednesday of every month from 1 to 2 Central Time.
Okay.
But I am doing one that I've actually started, and it's going to be from 10 to 10:30 a.m. Central Time. So that's 10 to 10:30 Central Time.
Okay.
On Fridays. That is starting in June. So it starts in June. So it'll be every Friday. If you need to get the link, let me know, because it is a registration link, because I have to have that. But I'm more than willing, and it's just all I do is sales concepts. It is not I am not going to talk about product. I mean, I may talk about it for 2 minutes, but I'm talking about sales concepts to help get you an opportunity to drive business. So,
and that was what endeared you to me from the very beginning. Is it's not about the product. Product is product. It's about the value and the support in terms of revenue generating ideas. That's what you get when you're talking to Rodney, and we really appreciate that. And to all of our Xperia champions, if you're not an executive director, tune in to Rodney's the first Wednesday of every month. He's got a webinar, and as well on Fridays starting in June, you can tune into those. That information will be in the back office once I have it available to myself. And to our Xperia Nation, just thank you so much for tuning in again today. If you've got ideas or strategies or concepts that you'd like us to cover, please share that with me. I'd be happy to do so. Otherwise, create a great day, and thank you so much.
Thanks, Shawn.
Thanks for watching Xcelerate. I have another great video right here, so check it out. And remember, Xperia Financial Group is about real people, real ownership, and real change. Let us help you accelerate your growth.